This is the study session on derivatives and the reading on basics of derivative pricing and valuation, which sounds an awful lot like the command words should have compute or calculate in them. But note that none of those command words ask you to do such a thing. Most of the command words are explain and define and distinguish and identify. But the cool thing about this reading is that in order to be able to understand and explain and distinguish, we're going to have to understand some of the mathematics behind this. So we'll go ahead and get our calculators out and do a little bit of math. Let's get to that first LOS. Explain how the concepts of arbitrage, replication, and risk neutrality are used in pricing of derivatives. So let's start with arbitration. Let me give you a quick definition here. Exists when equivalent assets or combination of assets sell for two different prices. And the simplest example of all is, suppose a share of stock trades for $100 on the floor of the New York Stock Exchange and only $95 on the floor of the Philadelphia Stock Exchange. Well, you could go to Philadelphia and buy for $95 and then go to New York and sell for $100. Forget about driving costs and traffic and all that stuff. Just suppose you can do this instantaneously on a computer. Well, you would do this over and over and over and over again. You would be taking no risk, right? And you would be generating some kind of a positive return. How about this concept of replication? Replication refers to the creation of an asset or a portfolio by using a combination of other assets or portfolios, plus being able to layer those assets and portfolios with derivative securities. And so that's why the CFA program emphasizes throughout level 1, 2, and 3 the importance of derivatives, because we can use derivatives to do all sorts of really, really cool stuff. Let's take a look at a real simple example here of replication. If we take the long position in an asset and we use the short position in the derivative on that asset, what we're going to do is generate the identical scenario under which if we were long in the risk-free asset. All right, so that might sound a little strange there with those boxes. So let me give you an example. Simplest example that I could think of. My family and I, we love these Honeycrisp apples. Have you had Honeycrisp apples? I mean, they're so expensive, but they're so great. So let's suppose that Honeycrisp apples spot price $5 per pound, way expensive. And the 1 year forward price on a Honeycrisp apple is $5.30 per pound, and the risk-free rate is 6%. All right, so what could an investor do? An investor could take $5 and invest that in a bank and earn that 6% rate of return, and in 1 year would have $5.30, right? I got that by just taking 5 times 1.06 raised to the first power. Or that investor could go out and buy an apple today for $5 and then agree to sell it using a forward contract and receive that forward price of $5.30 in 1 year at the maturity date of the contract. And so note what's happening here. The investor has a choice. Could either go down to the bank and invest in some kind of a savings account or invest in an apple. Either way, the future value is going to be $5.30. And so since those payoffs are identical, then their present values must be identical as well. And so this is the idea of replication. You could go to the bank and get $5.30, or you could go to the Apple market and you would have $5.30 at some time in the future. Now, forget about my example in terms of, wear and tear or storage on the Apple. But you could apply this to gold, or you could apply this to a share of stock or a bond or the S&P 500 index, in which there is no wear and tear and there is no storage costs. Now, what we can do to advance this discussion on replication is to use that first formula there. So what did I say? Let's go back here real quick. What did we do? We own the Apple, right? We took the short position in the forward market because we were going to sell, and that gave us the same return as the long position in the risk-free asset. All right, so what we're going to do in this next slide is just use simple algebra and move one box to the other side of the equal sign and another box to the other side of the equal sign, so you can get a sense of what these combinations are and how they're able to produce the equivalent single asset. And that's what the arrows are. We're just, from the first equation to the second equation, we're just switching those two boxes on the right hand, right around the equal sign. And then in the last formula, we're doing we're eliminating the middle box and moving those around. All right, how about the last part of this LOS, risk neutrality? So risk neutrality is somewhere in the middle, right? It's risk neutral. So you have those investors who are risk seekers over here, and then you have those investors who are risk averters over here. And risk neutral investors are just individuals who are neutral towards risk, which means that their entire focus is on compensation or the required return. And so risk neutral derivative pricing is extremely important in the concept of derivative pricing, in that it relies on arbitrage opportunities, guaranteeing that a risk-free portfolio can be generated by using a risky equity security or a risky apple and some kind of a derivative. And so there's only one derivative price that meets that condition. And so there's that formula that we used just a moment ago. How about this LOS? Distinguish between value and price of forward and futures derivative contracts. Yeah, this is an important distinction in the derivatives terminology. At the inception, in other words, when the two parties sign a forward or a futures contract, the value is always set at 0 because you're just simply agreeing to do something in the future, whether it's a forward or a futures contract, whether it's trading an Apple or trading the S&P 500 index or trading an interest rate. Two parties just agree and they shake hands and say, hey, at some time in the future, we're going to get together and trade. And so there's really no money required. I mean, this is why derivatives are called highly leveraged, because you can take a giant position in an underlying asset without having to put up any money. And so that's the important concept here, that the initial value is always 0, so that there's no penalty for each party to get in, and it reflects the fact that no capital changes hands. Now, the forward value probably begins somewhere where the owner of the underlying asset has to store the asset, like the Apple that we just talked about. And so what happens then is that the forward value will tend to move. It will tend to move towards that forward price as the contract approaches maturity. And then at maturity date, the spot price and the forward price or the futures price are going to converge. We'll talk at length about convergence at level 2. Now, the price of that forward or futures contract at inception is the price that the two parties agree to trade at some time in the future. And so that's fixed. All right, so notice the little timeline I have there. At initiation, value is 0. And then the price is going to be, well, whatever that price is, right? The price of that forward contract, what was it in my previous example? $5.30. And then throughout time, at the end, then the value and the price at the maturity date are going to equal each other. Here's a great LOS that should say compute the value and the price of the forward contract, but it just asks us to explain. So we're going to use a couple of formulas here, and then I have a good example. So at initiation, there's the value set at 0. The forward price is going to be just the future value of the spot price. I mean, that should make perfect sense, that if the spot price of the Apple today is 5, and then if we have to store, or we have the choice to use a savings account or a risk-free asset, well, then that forward price has to be a function of the spot price plus some time value of money. All right, so notice that the forward price is the future value of the spot price. All right. And then let's skip all the way to maturity here for just a second. The value at maturity is just going to be the difference between that forward price that was established at the beginning, at inception, and is fixed, and the spot price. Did I say difference? Yeah, the difference between those two. So the spot price at the maturity date of the contract minus that fixed forward price, that's going to determine the value. But what do we know about spot prices between initiation and the maturity date of the contract? They're going to go up and they're going to go down and they're going to go up. So the contract's value has to change over time, right? So as the price goes way, way up, as the spot price goes way, way up, well, then one position is going to benefit. If the price goes way, way down, then the other position is going to benefit. And so notice that the value is simply the difference between the spot price at any time during that contract's life, which is denoted as lowercase t, minus, now look at that thing there. That's going to be the future value of the spot price, right, over there on that left-hand equation, discounted back to the present. At the risk of offending you, notice that over on the left-hand side, we raised the 1 plus r to the t power, the positive t power. So that means we're computing future value. But in this middle equation, we're raising it to the minus t, which is the long t, minus the short t. And since we raise it to the negative power, we're taking present value. Let me show you what I mean there mathematically. So let's work through a quick example. Let's suppose that we're a bakery and we want to buy 100 pounds of Honeycrisp apples in 1 year. And so what's our risk as the bakery? Our risk is that commodity prices, in this case, the price of Honeycrisp apples, skyrockets, right? We want to make our Honeycrisp apples for the least amount of capital. Remember, positive net present value projects, all that kind of good stuff back from our corporate finance days. So what the bakery wants to do is hedge that commodity price risk by locking in a future buying price. All right, so let's suppose there's a forward contract and I have the same details from a previous slide. Spot price is $5, time is 1 year, and then the risk-free rate is 6%. All right, so the forward price then is the $5 times 1.06 raised to the first power, which is a future value, right? So that's $5.30. And so the bakery agrees to buy 100 pounds of apples for $530. In 1 year, no money changes hands, value of the contract is 0. Now, what we could do is to determine what the value of that contract is over the life of that contract, but I just picked 9 months for scenario 1 and scenario 2. So let's suppose that 9 months has gone by and the spot price is now $4.90. So if you're the bakery, what have you done? You had agreed to buy these apples at $5.30, right? But the spot price is now below that. So you're thinking, oh my gosh, I'm losing. This is a losing proposition. And so the value of the contract using that formula here, let me go right back here, look at that middle formula there. So the value of that contract is $4.90 minus the $5.30, and then we're going to take that present value. And so where did I get the minus 2.5? So 1 year contract, after 9 months, we have a fourth of the year left, right? 9 divided by 12, that's 3/4, so we only have 1/4 left. So that gives you a minus 323, and for 100 pounds, the value of that contract is $32.30. So if the bakery wants to get out of that contract, he or she will have to pay that $32.30 because the price has moved against him or her in the derivative market. And then just really quickly here, if we have scenario 2, if the spot price is $5.50, well, then the bakery is saying, oh my gosh, this is so cool. I decided to enter that forward contract. I only have to pay $5.30, but now the price is all the way up to $5.50. Thank heavens I entered this contract. And so the value there, doing the same kind of math, is 277. So the value of the contract is $27.70. And so if the bakery wants to get out of the contract, someone will pay him $27.70. Him or her. Let's skip then to the maturity date of the contract. Suppose the final spot price is $6. Well, then the value of the contract at maturity is the 6 minus the 530, and that's a total of $700. So think about what's going on here. The LOS asks us to explain, and clearly, at least to me, clearly understanding the mathematics behind this and doing just some quick math and working through this problem in which we have the scenario under which prices go up and prices go down. I think this goes a long way in helping you guys be able to explain value and prices. All right, how about monetary and non-monetary benefits and costs associated with holding the underlying asset. All right, so what do we know? Let's go back to my apple example. If we're a farmer and we have that apple today, we could sell it for $5, but we could enter a forward contract and agree to sell it for $5.30 1 year from today. Well, what that implies is that the costs of storage and the costs of insurance and the cost of protecting the integrity of the underlying asset, boy, they better be less than $30. What did I say? 500 and 530. They better be less than $30. Otherwise, we'd be better off just selling the apple today. So there are costs and there are benefits associated with owning the underlying asset. And so what did I have written in the second bullet point? Costs usually refer to storage costs, withholding, warehouse costs, and rent and insurance, all that kind of stuff. Benefits. The benefits refer to monetary benefits associated with holding the underlying asset. In other words, if you get the interest payment and you get the dividend payment, because you don't get any of that stuff when you own the derivative. And there's also this convenience yield, which I'm not quite sure applies much to our apple. I guess we could eat the apple. That's a convenience yield, but we better get a lot of satisfaction out of eating the apple rather than selling it for $5.30 in a year. But this applies when owning a share of stock in a forward contract, owning a share of stock. Suppose that you own the share of stock. It's better than owning the forward contract, because what happens? What happens if this company says something like, hey, we made tons and tons of cash flows last year. We're going to pay a special one-time only $20 per share dividend. Well, owning that stock, that's kind of like a convenience yield. All right, so this is important. Look at the note there. Costs increase the forward price while benefits reduce the forward price. How about a forward rate agreement? This is a simple derivative in which two parties agree to exchange interest rates on a notional amount. I mean, it could be $10 or it could be $10 trillion, but essentially what's happening is that one party agrees to pay a fixed rate and the other party agrees to pay a variable rate, a forward rate agreement. The buyer of the FRA enters into the contract to protect from increases in interest rates, and then the seller protects from a decline in interest rates. So essentially, the define here of the forward rate agreement. So we're going to exchange these fixed versus the floating payments. But also, they explain these things is that the reason that they're so popular is because one party thinks rates are going to go up, and one party thinks that rates are going to go down. So you get two people who are agreeing to make a bet on interest rates, and these are over-the-counter products. Now, the simplest answer to explain this LOS, why do forward and futures prices differ, is the following, is that forward contracts are almost always tailored and customized to the unique characteristics of the borrower and the seller. Futures contracts, however, are standardized and are traded on an organized exchange. And so the simple fact that one is going to have tons and tons of extra liquidity and extra marketability than the other ones must mean that there are slight differences in those prices even when the underlying asset is identical. And so, let's go back to my Honeycrisp apple example. If you have a forward contract on the Honeycrisp apple, there's no marking to market between now and 1 year from now. There are changes in the value. And in my example, I said that whether prices go up or down, the bakery would have to either pay or they would get to receive, whatever that was, like the $27 and the $32. But that's if there is a secondary market. And a lot of times in forward markets, there are no secondary markets. But in futures markets, there's a tremendous secondary market. You can get out of these things. You can get in and out of these things every day, every minute of every day. And marking to market occurs can occur at every instance and every day. How about swap contracts? Swap contracts are really, really cool derivatives. And I used the example in the previous reading about two neighbors. One neighbor has an apple tree, maybe it's a Honeycrisp apple tree, and the other neighbor has a peach tree. And these two neighbors watch each other every morning. One person goes out and eats the apple, one person goes out and eats the peach, and so they agree to swap. Well, so a swap contract is a long-term contract in which these two parties agree to swap apples for peaches for, let's say, 10 years. But a forward contract is to exchange, can we exchange apples for peaches for a single time period? And then at the end of that single time period, we'd have to do it again and do it again and do it again. And so wouldn't it be just a lot easier for the neighbors just to sign a 10-year swap contract rather than a series of 1-year forward contracts? But here's the cool thing about this, that if you have a 1-year forward contract and then a 1-year swap, those two things are identical. The only time they differ is when it's a multi-period swap, and most swaps, in fact, are multi-period. And so the investors then, for a series of forward contracts, have to go back and renegotiate the terms, right? Renegotiate the terms every time period, whereas the swap counterparties, they never have to do it. They agreed at the beginning, and they just work their way through at the end. Here's another good difference between price and value of the swaps. All right, so a swap contract is a contractual agreement to exchange net cash flows. All right, maybe the apples and the peaches doesn't really apply to a bond and a share of stock, but you kind of get the idea that if investors want to trade, let's say, a fixed dividend payment for the return on the S&P 500 index, so the dividend payment is fixed, the return on the S&P 500 index is floating, and so these two parties agree to swap those cash flows. And by the way, they're always netted. In a swap contract, they're always netted. I mean, if I owe you $10 and you owe me $20, I'm not going to reach into my pocket and hand you a 10, and you're not going to reach into your pocket and hand me a 20. You're just going to pay me a 10, right? Now, the price of a swap, this is important. Swap pricing is the determination of the initial terms at the inception of the contract. So there's going to be a price at the inception, but value is going to be zero. And then just like throughout the life of our Honeycrisp Apple agreement forward contract, there's going to be a change in the value. And here's the really cool thing about the pricing of swaps. And we do this at level 2 next time around, and I'll show you how complex it can be. It's really just the difference between the present value of the fixed cash flows versus the present value of the floating cash flows. And so just like everything that I have said to you throughout all of these 58 readings, is that the price of any financial security is present value. And so that's true here with the swap as well. How about options? Explain how the value of a European option is determined at expiration. All right, so let's make sure we get to familiarize ourselves with the notation. So there's the call price. There's the price of the underlying asset. A lot of times it's used with the S for stock. X is the exercise price. P is the price of a European put option. And so here we are. We're at expiration. So we're not at when we buy the option, we're at the date when the option expires. So when the option expires, what do we know from our previous reading? We know that there is no longer any time value. So that the value of the option is going to be its intrinsic value, or it's going to be zero. So that's why I have on the slide and in the blue that it's going to be the maximum of zero and the intrinsic value of the option. And so the intrinsic value for a call option is the stock price minus the exercise price. And then the intrinsic value for a put option is the exercise price minus the stock price. So that should be pretty basic, but I have 3 examples here at the bottom of the page. The bottom of the slide. So let's suppose we have a stock price at expiration and an exercise price of a call option. So we have the right but not the obligation to buy at 90 when the stock price at expiration is 100. So what does that mean? Call price is $10. On the other hand, in example 2, if we have a stock price at expiration of 100 and our exercise price is 115, why in the world would we spend $115 when we could go to the New York Stock Exchange and pay just $100? This is an out of the money option, and so it is the maximum of 0, and so that's going to be 0, right? And then the same thing here in example 3, but this is a put option, so the stock price is 44, our exercise price of the put is 40. Why would we why would we sell for 40 when we can go to the New York Stock Exchange and sell for 44? So that put has no intrinsic value as well. All right, so this is good. Exercise value, time value, and the moneyness of an option. The exercise value of a European option is the value of the contract at expiration. All right, so the longer the time to expiration, the higher is the value of the European option. All right, and the moneyness of an option is depending on the relationship between the exercise price and the price of the underlying asset. All right, an at-the-money option is when the exercise price is equal to the current price. So there's a good example. If the S&P 500 index is 2650, and then the option has a call option or a put option has an exercise price of 2650, this is known as an at-the-money option. All right, so in the money is when the exercise price is less than the current stock price for a call, and just the opposite for a put. And let me just go back here to this one here, look at the blue. And so this is exactly what I said in that slide. An investor holds a call with a strike price of 150, and if the stock is currently trading at 156.70 is the option in the money. All right, you ready for this? So what do? We have the right, but not the obligation to buy, right? It's a call option. The right, but not the obligation to buy at 150. And the stock is currently trading at 156. If we went to the NASDAQ exchange, we'd have to pay 156. So of course, this option is in the money. And so here's a good time relationship. Notice we have time on the horizontal axis and then prices there on the vertical axis. So what was our exercise price? 150. So anytime that stock price is below 150, it's out of the money. Anytime it's at 150, it's in the money. I'm sorry. Anytime it's at 150, it's at the money. And anytime it's above, the stock price is above 150, it is in the money. Oh, I love this LOS, and you're going to love it even more when we get to level 2. Identify the factors. All right, so this is what we're doing here. We're going to go back and we're going to honor those 3 dudes who developed the Black-Scholes-Merton option pricing model, and they were the first to decide that there were and there are 5 important variables that determine the value of an option. First of all, the exercise price, which is always just determined by, either the buyer or the seller of the option. The risk-free rate, which is determined by, what's going on in the treasury market. And then the costs and the benefits of receiving changes in the stock price or the price of the underlying asset if the price goes up or the price goes down, and then volatility. And that's probably the most important one there, volatility. And so sounds like a great exam question to me. When the volatility goes up, so does the call price, so does the put price. This is probably a good table to memorize. How about put-call parity for options? Yeah, this is really a fascinating concept and one that's really, really important. Remember in one of our previous readings, we had a lengthy discussion on efficient markets hypothesis. And what we said was that stock prices, and that was our focus there, although in that reading I did say that it applies to all markets, but stock prices reflect all relevant and publicly available information. Remember, we went through all that things about the weak form and the semi-strong form and the strong form. Well, that efficient markets hypothesis can be extended to include the relationship between and among all these different markets. Remember back in the beginning, we had the Apple and we had the bank loan or the bank deposit and we had the forward contract. And so what put-call parity simply says is there has to be equilibrium between and among these different markets. If you don't like what's going on in one market, if you want to buy a share of stock, then what you can do is you can replicate that payoff in another market. And so put-call parity relies on efficiency and arbitrage between and among all of these markets. So what do I have written in that first bullet point? So since values of puts and calls are determined from the same underlying asset, There must be a relationship in their pricing, of course. This is called put-call parity. So let's go ahead and look at a couple of different strategies. What we can do is we know that we can always buy the share of stock, and then we can buy a put option on that share of stock to protect us against downside risk. And in fact, the payoff of owning the share of stock and owning a put option is going to be, the minimum payoff is always going to be the exercise price of that put option. Now, the maximum price is going to be infinity because the stock price can go up very, very high, right? Not to infinity, but some big number. So this is called a protective put. If we own the asset and we buy a put option, we're protecting the value of our underlying asset. All right. And so what the protective put does is it establishes a minimum value, a minimum future value of our total portfolio. Portfolio meaning that we own the stock and we own the put. Now, we can also invest in what's known as a fiduciary call option. And this is what we're going to do. We're going to buy a risk-free zero coupon bond. Now, this is an important part here. A risk-free zero coupon bond that has a face value equal to the exercise price of the option. Now, don't worry about finding a zero coupon bond and a put option or a call option that has an exercise price of $1,000, right? Because we know bonds mature for $1,000. Forget about that. Let's just suppose that you can find it. But what we're also going to do is we're going to buy a call option on that share of stock. And what that's going to do is that's going to give us a baseline, a minimum value that's equal to the exercise price of the option. And so whether or not we invest in a protective put or we invest in a fiduciary call, those two strategies are going to have the same payoff. They establish a minimum, but then they allow for price appreciation. So therefore, they must have the same present values. And there's the formula for put-call parity there at the top. And this is how you're going to memorize this. You think about this. You have four assets. You have a call option, you have a bond, you have a put option, and you have a share of stock. This is how you're going to memorize it. You're never, ever going to get confused if you think on one side of the equal sign is going to be just like the S&P 500 index. Just remember put-call parity, S&P. So look over there on the right-hand side. We have the stock and the put option. So there's S&P. And then you know you're going to buy the call option, and then you're going to buy the bond on the other side. Now, what you can do is you can use just simple algebra. You can add and subtract both sides of the equal sign. And so if we want to solve for the call, what we can do is take the present value of the exercise price, put it over to the other side. And what we can do is we can call that a synthetic call option. All right, so what can we do? We can go to the options exchange and buy the option for whatever the price is, or we can synthetically replicate the payoffs to that call option by going to the stock market, buying that stock, going to the option market and buying the put, and writing a risk-free bond. And then we can rearrange for the put option as well. So remember that you rearrange put-call parity to craft or to create a synthetic call or a synthetic put. All right, so here's the big thing. This goes all the way back to the first LOS, is that if you don't like what's going on in the option market, you can go to the other markets. You can go to the stock market and you can go to the bond market and you can replicate or you can generate a higher return in one market or the other. We call that an arbitrage opportunity. All right, let's do a quick example here. We've got European put and call options. Oh, I forgot to mention this, that when you do this put-call parity here, the call option and the put option, they have to have the same exercise price. All right, so that's shown here of $50, expires in, 4 months. Underlying asset price at $52. No cash payments. Okay, that's a simplifying assumption here. Risk-free rate $4.50. If the put is selling for $3.80, what should be the price of the call option? Wow, that sounds like a lot of stuff, but all we're going to do is use put-call parity, do a little algebra, and we'll solve for $6.52. if the call price is not $6.52, there's going to be an arbitrage opportunity. How cool is that? Now, there's also this thing called put-call forward parity, in which, now look at what we did back here. Let's look at that top formula. What we did is, way on the far right-hand side, we bought the underlying share of stock. But in put-call forward parity, instead of buying the underlying share of stock, we're going to enter into a forward contract. And that's really the only substitution here. So just look at the bottom there. The bottom formula is, all we're doing is, instead of having S over there, S&P, we're having the present value of the forward contract. And so that's really what put-call forward parity is, which tells us something really, really cool. Not only does there have to be equilibrium in, are you ready for this? What did we do back here? There has to be equilibrium in the options market, in the stock market, and in the credit markets, credit market meaning risk-free treasury market. Here, we're telling, this put-call forward parity is telling us there must be equilibrium in the options markets, in the credit markets, and in the forward markets. So the spot markets and the derivative markets are related. This is really cool stuff. Oh boy, I mentioned just a few slides ago the Black-Scholes-Merton option pricing model. We're going to do that at length in level 2. But at level 1, they want us to explain a one-period binomial model. And I'm going to try to do my best to convince you of how easy this thing is. So you ready for this? So the binomial option pricing model simply states the following: that the stock price today is whatever it is, whether it's $20 or $80 or $200. The stock price today has two possible paths in the future, one period. So that one period could be a day or a week or a month or a year, but it can either go up or it can either go down. All right, so look at the arrows. There's the U and the D for up and down. And so if the stock price goes up, it will be higher, S plus sub 1. It will be higher than S0. If it goes down, S minus sub 1. All right, so that's really simple. We're going to say the stock price today is $100, and it can either go up to $115 or it can go down to $93. I mean, pick your two numbers at time period 1. So that's all we're saying in that binomial model, is that stock prices have two paths. That's all they have, two paths. Not 100 paths, but just two paths. Now, before you start saying something like, oh, that doesn't sound very, very realistic, remember, what we're not trying to price the share of stock. We're going to use this model to price a call option. And what is really cool is this model uses all of the exact methods that we've been using to value other kinds of financial securities. All right, so let's go back to time period 0. What's the value of the call, C sub 0? Well, the value of the call depends on whether or not the stock price goes up or down, right? So if the stock price goes up, that's good news for us. If the stock price goes down, that's bad news for us if we own the call option, right? What do we want to do when we own the call option? We want to be able to exercise at the end of time period 1. All right, and so that call price at the end of time period 1 is going to be the maximum of either 0, right, 0, or the difference between the stock price and the exercise price. Remember, this is a call option. Now, I've said this repeatedly, that the value of any financial security is the present value of what you get out of that, or what you expect to get out of owning that security. So look at the formula down there in the middle of the slide. This is so cool. Look at this. The call price, C sub 0, is equal to, and let's forget about what pi means here. We're going to take the call price if the stock price goes up, plus the call price if the stock price goes down. We're going to weight those here, and I'll tell you about that in just a second. And we're going to divide by 1 plus the interest rate. So we're going to take the present value. So the call price today is nothing more than the present value of those future possible values that occur on the expiration date. Now, pi in that formula has to be some kind of a probability of the uptick or the downtick. And that probability is defined by that formula there, 1 plus r, which is just a regular old time value factor, minus the downtick. and then divided by the up minus the down tick. And this gives us a sense of volatility, right? If the up is just, if the stock price can go from 100 to 101 or 100 to 99, then the up and the down are really close to 1, right? But a lot of times they're not. So with lower values, there's going to be low volatility. Higher values, there's going to be high volatility. So let's go ahead and look at a quick example here. What is the value of a call option if the stock is currently at 50, exercise price is 52, risk-free rate is 5%, and assume that U and D are 1.2 and 0.75 respectively? Now, U and D are always going to be given in the problem. Let's not worry about where those numbers came from, especially since the LOS just asks us to explain. All right, so all we're doing is we're going to try to explain the value of the option, but we're going to do some math here. All right, so the stock price is $50. All right, so let's do the stock price path first. So that up and down are 1.2. So all we're doing is saying that the stock price can go up by 20%, right? That's 1 plus 20%. That gives us 1.2. So that's going to be $60. And the stock price could go down by 25%, right? So that gives us a D of 0.75. And so the stock price today is 50. It's either going to be 60 or $37.50. All right, nothing fancy about that. Well, how can we value a call option today written on that share of stock that is an exercise price of $52? Well, if the stock price goes up, we have the right to buy at 52, and the stock price is now 60. So the difference between those two, that's $8 worth of intrinsic value, right? So we will exercise a year from now and we'll get $8. But if the stock price goes down to $37.50, we have the right to buy at 52. Why on earth would we pay 52 with the derivative when we could go to the floor of the New York Stock Exchange and pay $37.50 for that? So our option is worthless, right, at expiration. So notice what is happening here. If we have the call, we're either going to get 8 a year from now if the stock price goes up, or we're going to get 0 if the stock price goes down. So let's value that option. Well, the first thing that we need to do is figure out pi. So let's take 1.05, there's that risk-free rate, minus the 75 in the numerator, and divide by 1.2 minus 75 in the denominator. So that gives us 67. So we multiply the uptick by 67%, and then we multiply the downtick by 33, although when the call price when the call is worth 0 at expiration, it doesn't matter what you multiply it by, it's still going to be 0. So we're really taking the present value, we divide by 1.05 of a 67% chance of getting $8. So there's the call price, $5.10. So what are we saying here? How do you explain the value of an option using the one-period binomial option pricing model? Here's how you explain it. You say that the call price today depends on the 2 paths that the underlying stock price can take over the next 1 period, and then just figure out what those intrinsic values are of the option and take the present value to get the call price. Isn't that a thing of beauty? Call price is the present value. Now, how about European and American options? How are those circumstances different, and explain those circumstances? And so here's my example that I like to give students all the time. Remember, the difference between the two is that with the European option, you have to wait until expiration, until the expiration date, until you can exercise. With the American option, you can do it at any time. Well, suppose that you know that the cash flows from the underlying asset, whether it's a share of stock like a dividend or a bond, and you get interest, and so you may want to exercise the option early, either to receive those payments or to get away from having to pay those payments, right? And so think about it this way: you have an American option, and let's just suppose that the call option is worth $10 and it has $8 of intrinsic value and $2 of time value. Well, you might decide to exercise the option because you think that this company is going to pay a huge dividend of, let's say, $20 a share next week. And so you want to exercise the option so that you own the share of stock so that you can receive that big dividend payment in the next couple of weeks or month, whatever it is. All right, that takes us through both derivative readings. That was a lot of fun for me. Remember to learn and familiarize yourself and understand the terminology, right? We've gone through a lot of these readings, and so we've emphasized the terminology for stocks, the terminology for bonds, and now we have the terminology for derivatives. And so that's really the first step. Understand all of the terminology and then go back and practice. Do some math to help you explain.